Welcome to Chapter 1. And in this chapter, we're going to do an overview of individual taxation, a little bit about the history of tax, and touch a little bit on how corporations are taxed. And all of these topics will be covered in greater depth in later chapters. So this is really just kind of a summary overview. So if you don't completely get it now, don't panic. We'll cover these things later. Although you should definitely spend some time on this because the things that we'll be doing later will definitely build on the concepts that are covered in this chapter. And I'm just going to skip over these learning objectives. You can pause this slide if you want more information on those. So some basic history on the tax law. In 1913, Congress passed the 16th Amendment, which gave the government the right to tax. And we'll talk about this later on in the term, but once in a while you'll see news stories on tax protesters. We had a very famous couple in our area in Plainfield, New Hampshire, Ed and Elaine Brown, that were tax protesters, and it resulted in a big FBI standoff. And the premise behind their argument was that the government had no right to tax them. And this was a really misguided belief because the 16th Amendment absolutely gives the government the right to tax its citizens. And the taxes serve a multitude of goals. It raises revenue, it funds the government, stimulates the economy, as we've seen very recently with the economic hardship packages that Congress has put together, the payroll protection, things like that. That's all funded with tax dollars. And so in addition, it funds our government, it pays for infrastructure, bridges, highways, all of those things. And without tax, we would essentially be facing fees for everything. And so in lieu of having everything be charged a fee, Congress imposes taxes, and it spreads the cost of operations of the government and the funding of programs across the population more broadly than if fees were charged. In 2017, we saw a sweeping change to the tax code, and Congress does this from time to time. The tax code will kind of get tweaked here and there along the way, and then every decade, 2 decades or so, Congress just makes a pretty massive change to the tax code. And we saw that in 2017 with the Tax Cuts and Jobs Act. And so just to highlight some of the things that happened, is that it reduced individual income tax rates. It increased the standard deduction, and we'll talk more about what that means, against suspension of personal exemptions. And in fact, all of these I'm not going to go into now because we'll cover all of these in much greater depth shortly. There was a cap on what you could deduct for state and local income tax, mortgage interest deduction, and it increased the child tax credit. So in terms of individuals and how taxes are reported, most individuals report taxes on Form 1040. And as a result of the Tax Cuts and Jobs Act, 3 schedules were added or created, I should say, that accompany that. And amusingly, the whole idea behind the Tax Cuts and Jobs Act, or not the whole idea, but you should be able to file your taxes on a postcard. And the president talked a lot about simplifying the tax structure so that you could file them on a postcard. Well, the postcard concept ended up not being practical or really possible. So we have a kind of a simplified Form 1040, but then you have several schedules to go with it. So we've got Schedule 1, which talks about additional kinds of income and deductions for adjusted gross income. Schedule 2 addresses additional taxes, and Schedule 3 credits and payments aside from withholding. So in addition to Schedules 1 through 3, there are 6 schedules which existed prior to the Tax Cuts and Jobs Act that also accompany a Form 1040. So Schedule A is itemized deductions. Schedule B is dividend and interest income that exceeds $1,500. Schedule C is what sole proprietors will file to claim business income and expenses. Schedule D is capital gains and losses. Schedule E is rental or royalty income, or individuals who have an interest in pass-through entities will also report their share of the entity income on Schedule E. And then Schedule F is farm and ranch income. Corporations, as a result of the Tax Cuts and Jobs Act, now pay a flat rate of 21%. Prior to the Tax Cuts and Jobs Act, it was a progressive rate, and the more they made, the higher their tax rate. And so this was changed to have all corporations paying a flat rate of 21%. A corporation files a Form 1120 when they report their taxes. There is also a Form 1120S, and that is for Subchapter S corporations. That's actually the how I operate my law practice is under Subchapter S. And as a Subchapter S, I am one of those pass-through entities where the corporation itself doesn't pay taxes, but I then report on my Schedule E of my individual taxes the profits from my Subchapter S corporation. We also have partnerships. Partnerships are formed on or are filed on Form 1065, and hopefully you'll remember from some of your other business courses that a partnership doesn't have to be a formal legal entity. It can be two people who come together and just say, hey, we want to form a partnership. And then in order to file the taxes for that partnership, those earnings from the efforts of those partners will be reported on Form 1065. Although the partnership itself won't pay tax, those two individuals will separately on their Schedule E report their proportional share of the partnership's taxes on their individual returns. So how do we calculate tax for individuals? Many of you probably have jobs where you get a paycheck and at the end of the year you get your W-2, and your W-2 has your gross earnings. And if you thought that those gross earnings was your taxable income, you would be incorrect on that. So there are a number of calculations that we make, and that starting point is that number on your W-2. And then from there, there might be some additions and subtractions, and that will then lead us to what is actually your taxable income. So, as I said, we would start with your gross income. That would be the number off your W-2. If you have multiple jobs, then we would add all of the numbers from all of your W-2s together. If you have a spouse and you were filing together, we would then, spouse's earnings would get calculated in there to come up with your gross income. We would subtract some deductions for adjusted gross income. Again, something we'll cover in greater depth later. And that gets us to adjusted gross income, also referred to as AGI. That's a term that's thrown around quite a bit in the media. And so if you hear references to AGI, it is adjusted gross income. Then individuals are entitled to a standard deduction, and as well as for married couples. And so you can either take your standard deduction, which is a flat amount, or you can take itemized deductions. And whether or not you decide that you're going to itemize your deductions generally depends on whether or not you have enough itemized deductions so that that would actually be more than the standard deduction. So if you have enough allowable itemized deductions that you could then take a bigger deduction than if you just took the standard, you would itemize your deductions. If you are operating a business and have qualified business income deduction, we would subtract that also from adjusted gross income. And so from the adjusted gross income, we subtract your deductions, either standard or itemized, whichever you choose. If you are operating a business, we would also subtract the QBI deduction, and that gets us to your taxable income. We multiply the taxable income by your tax rate, and we'll get into the tax tables later. And then this tells us what your income tax liability is. Now, if you are working for an employer, that employer should be taking taxes, federal withholding taxes, out of your paycheck every pay period, and those will also appear on your W-2. So we look at how much you paid in, how much did your employer take from your pay every pay period, and we subtract that from the taxable income. Now, hopefully, you told your employer to take out the right amount so that you don't owe any money at the end, and maybe you get a little bit back in the form of a refund. On the other hand, if you told your employer not to take enough out, you might have a big fat tax bill here at the end of this calculation. So we're going to examine these individual components of that calculation, what gets us to how much tax we owe, a little bit in greater depth here. So we talked about gross income, and most commonly for people, those are wages. But if you've got money in the bank and the bank is paying you interest, any interest that you earn on money that you have in a savings account or some sort of an interest-bearing account also gets calculated into your gross income. If you have stock and the stock pays a dividend, that dividend similarly is part of your gross income. If you are retired and you receive a pension, yes, that pension money, your retirement income, is going to be taxed. And so that becomes part of gross income. This next item, Social Security, this can be a bit of a shocker for people. They think, well, they worked all their lives, they paid into Social Security, and now what? The government is going to consider Social Security part of gross income for income tax purposes? Yes. And this is often a bitter pill to swallow for folks who thought that their Social Security income in retirement would be tax-free. And it isn't quite as draconian as I'm making it out to sound, and we'll get into that a bit more in weeks to come. But generally speaking, yes, your gross income includes any Social Security that you receive, as well as capital gains and losses. Now, those deductions for adjusted gross income then are taken into consideration before we get to your adjusted gross income. And those are so if you are in business for yourself and you've got expenses associated with that business, of course we're going to let you deduct those business expenses. We're not going to tell you that you're going to pay income tax based on all the revenue that the business takes in and not let you have credit for any of the expenses of operating the business. They're definitely going to give you credit for that. If there is a reimbursement plan for employee business expenses, that is something that we would also deduct. So if, for example, your employer has a plan where you get a reimbursement for certain expenses that you're required to front on behalf of the employer, sometimes those can be deducted from your income if your employer reports those as income to you. Prior to 2019, a spouse or an ex-spouse, I guess I should say, who was required to pay alimony to the former spouse could deduct that alimony payment from their income. And so child support, on the other hand, not deductible. So often when couples were getting divorced, the spouse who was going to be doing the paying would want the payment to be calculated and categorized as alimony so that he could take it, and I say he because quite often it's the former husband that's paying the maintenance payment. But the former husband would want it considered alimony so he could take a deduction on his taxes. On the other hand, the former wife who was receiving the money, If it was alimony, she would have to pay taxes on it. If it was child support, it is tax-free. Similarly, if the husband had been paying it as child support, not as alimony, he would not have been able to take that deduction. So quite often in divorce cases, there was a battle as to whether or not that was something that was considered alimony or child support for tax purposes, because there was a significant tax either benefit or consequence depending on how that was calculated and which party was going to be receiving or paying. In 2009, or excuse me, 2019, that ended. And so no longer can alimony for any new or alimony awards be deductible. If the alimony was established prior to this sunset at the end of 2018, they can still deduct that going forward. They just, no new divorces can result in a new deduction for alimony. Student loan interest, up to a certain amount, is deductible from adjusted gross income as well. If you have for example, a certificate of deposit, and you are supposed to keep it in there for a certain amount of time, and you really need that money, and you go get it early, and you're penalized for that, you can deduct the penalty on the early withdrawal. If you make contributions to qualified retirement plans, specifically an IRA, if you are self-employed and you don't have a pension plan, often people will contribute to an individual retirement account, and those contributions can be deducted from adjusted gross income, as well as certain educator expenses. So if you've got a tax client, for example, that is a full-time kindergarten through 12, even though I'm an educator, they stop it for anybody who teaches above 12th grade, unfortunately. But they can deduct up to a certain amount the money that they spend on classroom supplies. And so these are deductions from gross income. And so once we subtract any of these deductions that exist from somebody's gross income, that leads us to the adjusted gross income. And so, and as your slide says, that's often the magic line. So eligibility for certain kinds of tax relief often can be based on adjusted gross income. You know, we saw very recently with stimulus payments, that was tied to income as well. And so sometimes that magic line can be very significant and can result in the loss or of, if someone exceeds it, of some deductions. Now, I'm aware this video is getting a little long, but I want to try and wind up this topic before I stop this video and move on to the next one. So I'm just going to briefly hit on these last few concepts here. I had talked when we were looking at the formula about standard versus itemized deductions. So depending on your filing status, that will determine the amount of your standard deduction that's available. So and this changes annually. So for 2019, which is the tax year that everything for this course will be based on, by the way, single individuals can get a $12,200 deduction. Spouses who are married filing jointly can get $24,400, so basically the double of the standard deduction. If you're married and filing separately, each spouse basically is treated like they're single for standard deduction purposes. Head of household, so if you've got a single parent with some kids at home, you cannot be married and claim head of household, as an FYI. But head of household, $18,350, and a qualifying widower, so somebody whose spouse has died that year, gets basically as if they were married, even though it's now just a single surviving spouse. There are also some additions to the standard deduction if you meet certain criteria. So if you are blind or over age 65, you get some additional additions to your standard deduction. Now, prior to the Tax Cuts and Jobs Act, And the only reason that we're really even going into this is because this provision of the Tax Cuts and Jobs Act, as many of the provisions are only temporary. So we may, unless Congress does something to extend this provision, see a return of exemptions in 2025 when this provision is scheduled to sunset. But prior to the Tax Cuts and Jobs Act, you got an exemption for each dependent that you had on your taxes, as well as for the taxpayers themselves. So a husband and wife and 2 kids got 4 exemptions, and there was an additional deduction that you could have for each exemption. And when they took away the exemptions, they increased the standard deduction, which if you were a husband and wife with no kids at home, was probably a benefit to you. On the other hand, if you were a husband and wife and had 8 kids, that was now a problem, because prior to the Tax Cuts and Jobs Act, each of those 8 children gave you an additional deduction off your taxes. Now it doesn't matter how many kids you have, for standard deduction purposes, you don't get an additional standard deduction. You may be entitled to some tax credits, but that's a topic for a different day. So again, once we return to the pre-Tax Cuts and Jobs Act law, there may be the requirement to take some additional deductions based on the number of exemptions, but for now, we're just going to ignore that until 2025. And so we have our adjusted gross income, we subtract, and in this case, we're just going to talk about standard deductions at the moment, and that gets us our taxable income. And then we take that taxable income and determine what our tax liability is. How much tax were we required to pay based on how much, what our taxable income was, and that's determined by tax tables. So we're going to do a little bit of an example here, and then after this example, I will move on to a different video and give you a break. So we have Bill. He is a single taxpayer. He is 27 years old. In 2019, his salary is $29,000, and he has interest income of $1,500. So automatically you're thinking, okay, gross income. So we've got some gross income here. He has additional deductions for AGI of $2,200, and they don't tell us what those are. They're not going to make us think that hard. They're just going to tell us he gets them. There are also itemized deductions of $6,500. So what they want us to do is calculate Bill's taxable income. And so we've got, and I'll move on in a second to the solutions, but let's just talk this through for a minute. So we know that his earnings, $2,900, are part of his gross income, and the interest income as well, also part of his gross income. So his gross income is going to be $30,500. And then he's got some adjustments for AGI. So we're going to subtract, and now I'm going to have to get my calculator out. So we had $30,500 of gross income. From that, we are going to subtract this $2,200. Sorry, I've decided to turn on my drawing tool here and see if I'm able to do this. Okay. Oh, this is painful. Okay, so $30,500. From that, we are able to deduct his $2,200 deduction for AGI. So that gets us to an adjusted gross income of $28,000. I promise I will come up with a better way to do this for future videos. This is just a whim. But $28,300 is his adjusted gross income. Now, we have the standard deduction or the itemized deduction amount. Well, let's see. So we know that he's a single guy, and he gets the standard deduction, or he's got $6,500 in itemized deductions. So if you remember from the prior slide, a single person for 2019 gets a standard deduction of $12,200. And he cannot take both the standard and the itemized. So it makes no sense for Bill to take the itemized deduction of $6,500 because he'd be cheating himself. He'd be much better off with the standard deduction of $12,200. And so we just ignore the itemized deductions because they do not benefit him. And so that gets us down to, and I'm not going to do the math in my head, but $16,100 for taxable income. Okay, and so we move on here to our solution, and we see that yes, in fact, he had gross income of $30,500, and his adjusted gross income was $28,300 as a result of subtracting the deductions for AGI. The $12,200 was the appropriate standard deduction, and we took that because that was more favorable to him than taking the itemized deduction of $6,500. And that gave him taxable income of $28,300 minus $12,200, $16,100. And so I'm going to stop this video at this point. Again, I apologize for the length, and we'll move on to the next video for who must file a tax return.